Hello everyone, welcome back. Since we covered market structure, liquidity and Fibonacci, learning how to understand direction, identify targets and measure pullbacks, now the next questions are: how do we know if a move is actually strong or just noise? And where has most of the trading activity happened? That's where volume comes in. In this video, I'll break down what volume really measures, how to use volume bars, fixed range volume profile and anchored volume profile, and common mistakes. Let's get into it. What volume actually measures? Volume represents how much trading activity is happening in the market. In simple terms, it tells us how many transactions are taking place. But more importantly, volume gives us insight into participation and interest. Think of it like this. Price tells us what is happening. Volume tells you how much conviction is behind it. For example, a price move with low volume might mean weak participation, lack of conviction, and potential fake move, while a move on strong high volume usually means strong participation, real interest, and higher probability of continuation. So, volume helps us understand whether a move is supported or not. There are different ways to use volume in trading, and each tool gives you a different type of information. Let's break down the three most important ones. So you can look at volume in its simple form, volume bars. And it looks like this. It's an indicator that appears at the bottom of your chart, and you can find it by searching indicators by volume, and you'll have it here. Volume bars tells us how much trading activity is happening in one candle, depending on the specific time frame you're looking at. On higher time frames, volume helps you understand the overall participation and conviction. On lower time frames, it helps you spot immediate intent and short-term momentum shifts. One of the most important things to watch is volume spikes. A volume spike happens when trading activity suddenly increases. These spikes often indicate that something important is happening in the market. Strong buying or selling pressure, large players entering or exiting, reactions at key levels. If you see a volume spike at a key level, it often means that level matters. For example, price reaches support, volume spikes, price reacts. That suggests buyers are stepping in with intent. It's simple to visualize on the chart. A volume spike is a candle down here that stands out from the previous candles. You always look at volume bars compared to previous recent bars. Tall bars mean strong participation, small bars mean lower participation. But there's a limitation. Volume bars don't tell us where that activity is happening on the chart. And that's a problem, because in trading, where something happens is just as important as where it happens. So the real question becomes, where is the market actually spending the most volume? Where are traders getting involved? Where is price being accepted or rejected? And this is where fixed range volume profile comes in. Instead of showing volume over time, it shows volume at specific price levels. And that gives us a much deeper understanding of how the market is behaving. And this is how it looks like. First of all, you'll find the fixed range volume profile on the left bar of the TradingView. Here, under the fourth option, in the middle, we have fixed range volume profile. And on our chart, looks like this. It shows us high volume nodes, areas where the market spent a lot of time, low volume nodes, areas where price moved quickly, the point of control, the price level where the most volume was traded, value area high and value area low, which is the range where 70% of the total volume was traded. High volume areas often act as support and resistance or zones of acceptance. Low volume areas often act as fast-moving zones and areas where price moves quickly through. The most important level is point of control. It represents the price where the highest amount of trading activity happened within that range. This level often acts as a key support or resistance, a magnet for price, or a level where the market may return to. Because so many trades were executed there, it reflects an area of strong agreement between buyers and sellers. The last one, anchored volume profile, is similar to the fixed range volume, but instead of selecting a range manually, you anchor it to a specific point in the market, like a swing high or swing low, a breakout level, or a major reaction point. From that moment, the tool tracks how volume develops as price moves forward. This helps you understand where positions are being built, how value is shifting over time, and which areas are becoming important. This is how it looks like on our chart. We have volume nodes, point of control, value area high and value area low, exactly as on the fixed volume profile. It just depends how you anchor it on the chart, starting from a specific point in time. Anchor volume profile is especially useful in trending markets because it shows how volume evolves from a key event. Each tool gives you a different perspective. Volume bars shows you activity over time. Fixed range volume profile, it shows volume at price. And anchored profile, volume development from a key point. When you combine all three, you get a much clearer picture of strength, location, and context. Now that we know how the tools work, let's go over some of the common mistakes beginners do. Starting with the first one, ignoring volume. One of the biggest mistakes is simply not using volume at all. Many traders only look at price, drawing levels, patterns, or indicators, without considering how much participation is behind the move. But price alone doesn't tell the full story. A move can look strong on the chart, but if it happens on low volume, it may lack real conviction. Volume helps you answer, is this move supported or is it weak? Ignoring volume means you're missing a key information about market intent. Mistake number 2. Assuming all high volume means reversal. This is not true. High volume simply means a lot of activity is happening. That activity can be strong buying, continuation upward, strong selling, continuation downward, or absorption, potential reversal. Context is everything. So instead of assuming what volume means, always ask what is happening at this level and in this context. Mistake number 3. Volume should never be used in isolation. Looking at volume without structure is like having half the picture. For example, a volume spike in the middle of nowhere doesn't mean much. But a volume spike at a key support or resistance level, a Fibonacci zone, a liquidity area, or a volume profile level becomes much more meaningful. Structure tells you where to look. Volume tells you what's happening there. Mistake number 4. Reacting to every volume spike without context. Not every spike is important. Some of them happen due to news events, short-term volatility, or low time frame noise. What matters is how volume behaves relative to recent activity. A spike is only meaningful if it stands out compared to what came before it. And the last one, mistake number 5, using volume without time frame context. Volume behaves differently depending on the time frame. A spike on the daily chart is very different from a spike on the 5-minute chart. Higher time frame volume means broader participation. Lower time frame volume means immediate intent. If you don't consider time frame, you may overreact to moves that are just short-term noise. Volume is not a standalone signal, it's a confirmation tool. So, the key idea from this lesson is simple. Volume bars tells you when activity happens. Volume profile tells you where it happens. And anchored volume shows you how it develops over time. By combining volume bars for timing, volume profile for location, and anchor volume for context, you start to see the market in a much clearer way. Not just what price is doing, but why it's moving and where activity is actually happening. And this is where things get even more interesting. In the next video, we're going to talk about VWAP. VWAP is one of the most important tools and stands for Volume Weighted Average Price. It represents the average price the market has traded at, weighted by volume. When you combine VWAP with everything we covered, volume, structure, and liquidity, it becomes a very powerful framework for trading. Until next time, good luck trading. Bye bye!